Albert Einstein said, "He who understands it earns it. He who doesn't pays it." In order to understand compound interest, first we must understand interest and the definition of interest. So here's the definition. Money paid regularly at a particular rate for the use of money lent or for delaying the repayment of debt. Isn't that interesting what the definition was? Because that's what most people think of interest, right? They think of the interest rate associated with their credit card, the interest they got to pay on their mortgage, the interest they got to pay on their car payment, the interest they pay on everything. That's what most people think of when I say the word interest. However, if I say the word compound interest, in the eyes of the wealthy, they see it as a completely different thing. They see it as their money working for them. They have literally mastered the art of figuring out how money can work for them, which is very different than what I just mentioned, somebody looking at interest as what they have to pay, where the other side looks at interest as what they have to earn by their money working for them. That is the key differentiation between what we're talking about. How do the poor and how do the wealthy look at this word called interest? Now let's look at the definition of compound interest because it's very different. According to the Webster's Dictionary, compound interest is interest calculated on both the principal and the accumulated interest. Let me repeat that just so that it sinks in a little bit. Interest calculated on both the principal and the accumulated interest. This means that you earn interest not only on the initial amount you put in, but also interest on the money you've already earned. That is unbelievable when you really think of the power behind that description. And you know, Warren Buffett actually said, if poor people would just do what rich people do, they wouldn't be poor anymore. So what do the rich do? They understand compound interest. And some of the unique ultra wealthy understand how to earn uninterrupted compound interest, something I teach all the time, but there's really only a couple vehicles on earth, really specifically one, that can pay you compound interest, but do it on an uninterrupted basis, and that is specially designed and engineered whole life insurance from a mutually owned company that pays dividends. That's correct, because you can earn compound interest while still using the money and you don't interrupt it when you use the money. Well, we're not going to get into that today, but just think of how cool that would be. So what I thought I'd do to explain compound interest is just do a little visual representation. Now we all know that we go out there and we make money, right? We trade our hours for the money. Now what do we do with our money after we earn it? Well, most of you put it in the bank. And in the bank account, your money can earn compound interest, just like it can earn compound interest inside of a whole life policy, inside of a brokerage account. But you're always got to make an initial investment. So I'm going to take $100 of the money that I make, and I'm going to make that my initial investment, or my initial amount that I saved. And that money is going to compound at a rate of 10%. Now, let me just ask everybody, do you have a bank account that will pay you 10%? Do you have any other kind of brokerage account that will pay you 10% on a pretty regular basis? Probably not. So if we can, I'm just going to talk about private lending. We've created a website called Private Money Club, and I can get 10% on just about any deal in a first lien position, and I get paid monthly. So I got $100 in this initial investment, and it pays me 10%. So if we go to the first full year, how much money do I have? Well, I have the 100 plus the 10 extra dollars that I made. So now I have $110. And then after that first year, if we move on to the second year, how much money do I have? I started with 100. The second year I have 110. So now I have $110 in this first year. So if I go into the second year, how much do I have? Well, I had 110 here, but that 110 earned interest, but compound interest. So how much did I make? Well, I didn't make $10. I made $11. So I have $121 in my account in the second year. I didn't have to work any harder for that. I didn't have to work any longer, and I didn't have to take on any additional risk. This is what Albert Einstein said. Those who understand it earn it. Those who don't pay it. Now, let's go on to the third and final year. In the second year, I had 121. So then in the third year, how much would I have? Let's see if any of you can get this right. See, compound interest is not easy to calculate. You need a compound interest calculator, or you just have to do it over and over. It takes some time. Your mind typically can't do that. So the third year, I would have made $12.10 because I've been compounding on the interest earned in the prior 2 years. So how much money do I have? $133.10. So I have $133.10. How much did I start with? $100. And it earned 10%. I now have $133.10 by the math. That's compound interest. So now, hopefully you understand it, and that means now you can earn it. But wouldn't it be really cool if we had a place where we could just put money and let it compound like this? But then we can just take all the money out and we can put it into another investment. And that other investment starts to earn money while this money continues to compound year over year. In other words, like, you liked how that worked for 3 years. Well, we went all the way out to 10 years. That'd be quite a bit of money just on the original 100. But now what if I used that money a second time and I never stopped the compounding on the initial $100 I put in? So now riddle me this. If I've got $133.10, how much do you think it'll be in year 4? Well, more than that, right? In year 5, but more than that. But now, what if I wanted to take the money out of this account? Okay, how much would I make in year 4? I'd make nothing, right? But what if my money never needed to leave this account? What if I still could take out the full $133.10 and I could use it somewhere else? Let's just say I could lend it out again at 15%, but my money still stayed in here. The $133.10 is still compounding, but I got $133 that I took out. And that $133 isn't my money, but my money collateralizes that. Let me give you an example. This is the easiest way for me to explain this. You've got $100,000. I'm just using a round number, but you got $100,000. And you walk into a traditional bank and you go to the bank and you say, how much money can you pay me on this $100,000? And they say 4%. So you give them the 100, they in turn give you 4%. So now you know that you're making $4,000 at the end of the year, correct? 100,000 times 4%. You walk out of that bank and you walk literally to the next block and you walk into another bank. Now you're holding the receipt for the $100,000 deposit you did in Bank A. And you go to the person at Bank B and you say, I just deposited $100,000 in this bank. Can I give you this deposit account? Can I put this up for collateral for a $50,000 loan? Bank B says, of course, we'll give you $50,000 if you collateralize it with the $100,000 on that bank down the street. Yeah, they give you $50,000 and they lend that $50,000 to you at 3%. I want you to think about that. You've got $100,000 earning 4%, still in the bank, still compounding at that 4%. You just walked down the street and you borrowed $50,000 from Bank B. That $50,000 from Bank B is going to charge you 3% because it's a fully collateralized loan, so they're willing to give you that money pretty cheap. So now you're making a spread. Your money's earning 4 while you're only paying 3, and you got to use it. You go below the $50,000. Now, you pass away. I don't mean to kill you off, but you pass away and go on to a better place. Bank B wants to collect on their $50,000. So they walk up the street to the other bank. They say, hey, we had a loan for this person who just passed away for 50 grand. Bank A then satisfies the loan out of the 100,000 with compounding, and then the remaining amount goes to the beneficiaries. Now that would be regular banks, but that explains exactly how a whole life insurance policy works. But we're not dealing with banks. Let's just say that those are insurance companies. The insurance company pays you 4%. The insurance company loans you money at 3%. You make a spread. Your money continues to compound like I just showed. But you then get to use the money and you get to go basically invest it again, spend it, blow it, do whatever you want. Don't blow it. That's not what we teach with the infinite banking concept. But hopefully that makes sense. You see, that happens every single day inside the infinite banking concept. So the infinite banking concept is the process of taking back the banking functions in your life. It is that, it is a process. The machine we use to run it is a specially designed whole life because the insurance companies will allow you to use a portion of your death benefit as long as you have cash value in the contract to collateralize that loan. Just like that Bank A, Bank B example. It's identical. That's what we do every day. And that's how our money makes a spread. And that's also how our money works twice as hard for us while still having the original money compounding uninterrupted. And then you can add the tax-free environment that whole life provides if built properly. So I don't want to go down the rabbit hole of that because I've got another video at the end I'll give you that'll teach you exactly how to do that. But I just want you to understand that when we think of interest, we always think of it in the wrong way. We think of it as how much interest do we have to pay. We got to start asking ourselves, how much interest will our money earn us? That's your money working for you. See, for the rest of your life, you can always trade your time for money, hours for dollars. And you're always going to limit the amount of money you can make because there's only 24 hours in the day, and that means there's only so few you can trade because you have to sleep, sometimes you want to go out and watch the football game, you got to go to the bathroom, and you got to eat. But you see, when you start thinking like the wealthy and you start thinking about your money working for you, you didn't have to work any harder for that. You didn't have to work any longer for that. You still got to watch the football game, you still got to eat, you still got to sleep, and you got to go to the bathroom, but your money doesn't have to sleep. Your money doesn't have to eat. Your money doesn't want to watch the football game. Your money will do whatever you tell it to do because your money is a tool that just needs direction, of which you have to provide your money that direction. And you also have to get your money in the right environment where it can earn compound interest uninterrupted and allow you to earn a spread just like a traditional bank. Folks, I hope this visual gives you a little bit deeper of an understanding of what the wealthy do to make their money work for them, so that you can mimic what the wealthy do and make your money work for you. If you liked this video, check this one out: how the wealthy use whole life insurance. Folks, thank you for joining me. We'll see you on the next one.